And so I want to ask you in regards to, because you were just mentioning, you not only are you
Mhm.
optimizing for, DPI, IRR, but there's
Mhm.
other data things that you're looking at to make sure when you're co-investing, you're deploying your own balance sheet and so forth. So what other data points are you looking at holistically? Because it is tough when you look at, okay, you got a year over year growth, but the valuation drastically decreased. And we're seeing just some of these companies, the metrics may not be as sexy as they were even just 18 months or 22 months ago and so forth. But you have to
Mhm.
look at the contextual story and what that data is telling you to say, okay, well, what are the projections in the next 2 to 3 years? And can we, obviously, like you mentioned, hey, can we come in at a good price to make sure that we are getting the alpha that obviously justifies the deployment of capital? So I want you to just kind of unpack a little bit the way you guys think about it as a very curated, structured investment thesis to ensure that you're mitigating the risk on the back end for yourself as well as for your LPs.
Absolutely. So I'll tell you this, right? What is really to me exciting about growth and late stage investing is how much of the story, right, matters at this point relative to the current macro environment and then public market as it relates to those comparable businesses that are already out there trading. And I feel for the companies that are still private companies and they really just don't have a strong public market comp. And I'll tell you one thing that I always feel bad about is everyone does their public comps analysis, right? What are the public companies that obviously trade on a relative basis that are they're most comparable to their late stage growth stage startup counterparts? And I always joke that I always feel bad for marketplace companies because there's like 1-800-Flowers that is always this comp for a marketplace company, and it doesn't always don't do so well. So it's always one of those where marketplace companies kind of get dinged because it's the running joke, at least for us internally, is another 1-800-Flowers comp. But anyway, with that said, here's the thing, Christian. Whether you are investing into a private company yourself, right, as a family office, a venture manager, whoever you are, or you're investing through a manager who's then deploying capital on your behalf through either their principal fund that you might be an LP in or through a co-investment vehicle, is do you believe the story of that growth? Right? Do you believe the story and how it's being shared with you, right? Whether it's directly through the company or through the manager providing you access. And when I say that, it's because ultimately, I think everyone in growth and late stage investing has looked to the teams, the management teams of these companies and said, are you being realistic with that forecast going out into the next couple years, right? Because what we're seeing, is the public companies who are reporting, right, quarterly. And, if they miss forecast these days across the tech sector by even a few points, they are getting decimated instantly. Decimated. And I mean by, they might miss forecast by 3 to 5%. We just saw this in a few companies that reported earnings this past month or so. And, their stock took massive 20 to 30% swings because of them missing forecast by a few points. And, I would say historically, the private markets have been much more forgiving when it comes to that, right? Because you might change the story. And obviously, we all went through the COVID headwinds, right? And saw our businesses change and our customers' budgets change. So we all had to react accordingly. But if I don't believe the CFO who's telling me, the venture manager, that story of their forecast, I just don't know whether I can, add that into my investment thesis underwriting and say that's a believable forecast. And obviously our job is to create our own model based on that story as well, which might actually be different than the company's ultimate forecast, right? And that's how every venture manager operates. But is it believable? Is it achievable? And I think one thing that does worry me by way of some of the analysis we've done on some of the AI companies are really big, very, very how do I put it, aggressive forecasts that I'm seeing out for some of their reporting as part of diligence, where I see AI companies forecasting 3,000, 4,000, 5,000% year over year growth going into the next few years. And at the end of the day, that has always worried me. Is that realistic? Is it conservative? But like I said, I think our job as a manager is we build our own forecast. And I think that's what makes it great for family offices who don't deploy in private company assets as their predominant investment strategy. It's one of several strategies as part of broader diversification. And so you have to believe the manager that you're investing alongside to say, are we providing you both the company forecast that we're aware of, or at least we've built, as well as our own, to say, is that actually achievable based on the story of the company, and are they being realistic? Because even though they're still private, what we don't want to see is that they created a story that they can't fulfill. And then, that goes into a next round of funding, and it leads to a down round, right? Or they go public, and then it leads to, some unfortunate earnings calls. So that story is so important. And we are storytellers, and we listen to a lot of stories as VCs. And so that's where we have to do a good job of saying, what is actually realistic in today's market.